Good morning and welcome everyone. My name is Hanson Borders, Managing Partner of Malden & Jenkins, and we're pleased to present this webinar on the recent Paycheck Protection Program Flexibility Act, or 3PFA, signed by President Trump on June 5th, which serves to relax certain provisions of the original Paycheck Protection Program under the CARES Act. Joining me today for the presentation is Jonathan Hightower and Kevin Strawn from the law firm of Kennemore, Kay, Harrison & Ford, and my fellow partners from Malden & Jenkins, Jeff DeCito, Ryan Enlow, and Carl Garner. The 3PFA has changed several key components of the original Paycheck Protection Program, and we will overview those changes. It is important that you contact your professional advisor or any of us to discuss all the implications of these changes, because although the goal was to provide flexibility and to simplify some parts of the 3P program, many complexities still exist. Our presentation today will focus on the changes from this act to the original Paycheck Protection Program. As we have navigated through this pandemic over the last several months, the continual message from the small business community was the need for more relief, clarity, and flexibility with this and other related programs. Congress, SBA, and the Treasury have attempted to answer that call by adding flexibility and simplification provisions to the 3P program. So with that, I will turn it over to Jonathan and the others to review the program, and I hope that there will be time for each of us to answer a few questions from you at the end, and we will certainly answer any follow-up questions after the conclusion of the webinar. Jonathan?
Well, thank you so much, Hanson, and good morning to everyone. I hope that everyone is doing well today and starting to see life get back to normal just a bit. We're very excited to be involved again with Malden & Jenkins and presenting some information about this new act, which all of us are really sort of struggling with what to call it. I'm just going to call it the Flexibility Act so I don't get tongue-tied over it. But to give you a little background on what Kevin and I do, we're banking lawyers. Our firm is a boutique firm with offices in Georgia, Texas, and Missouri, and we represent banks across the country. So we've looked at this quite a bit from a lender standpoint, and obviously all of our interests are aligned, whether you're a lender or a small business, in trying to maximize the forgiveness available through this program, and also just to do it right and comply with the many and various rules out there. So we're going to jump in and tell you what we know about this Flexibility Act. As Hanson said, hopefully we'll have some time to answer some questions at the end. But we look forward to going through this with our friends at Malden & Jenkins, and with that, I'll turn it over to Kevin.
Thanks, Jonathan. Good morning. So first slide here, we're going to talk about what the Flexibility Act did. And there's really, I think, two broad categories of its major impacts to think about. The first are the impacts on existing loans. And when we say existing loans, it's a little confusing. The Flexibility Act was signed on June 5th, which is, a Friday, 2 weeks ago. When we say existing loans, they've come out with some guidance that says that means that loans that got an SBA number or that were approved by the SBA prior to June 5th. So there could be loans that were approved on June 4th that the borrower didn't sign the documents until up to even 20 days later, or that that weren't dispersed for up to 20 days after that. And so it's a little confusing, but you've got to think about loans, loans that were approved by the SBA June 4th or prior are in one category, and loans that were approved by the SBA on June 5th or later in the second category. So for existing borrowers, they can now choose, for existing borrowers, meaning those loans that were approved prior to June 5th, they can choose a 24-week forgiveness period. And this is the covered period, which is how it's defined in the statute. Now, they still have the option of choosing the 8-week, or they can choose the 24. That should allow a lot more of them to get forgiveness. The deferral period in the original statute, as amended by a lot of the guidance that came out afterwards, was 6 months for everybody. That is now changed, and this is both for existing loans and for new loans, so that the deferral period will not end until the bank has received its reimbursement of forgiveness, which means, the 8 or 24-week covered period has to run. The borrower has to apply for forgiveness, and then the lender has to submit forgiveness to the SBA, and the SBA has to pay the lender that forgiveness amount, and that's when the borrower will have to start repaying the loan. The previous requirement that 75% of the forgiveness amount consist of payroll costs, that's been reduced to 60%. Maturity of loans for new loans that were not existing loans is now 5 years rather than 2. And this final point, that there were some exclusions in the original statute that said that some of the CARES Act payroll tax deferral benefits were not available to those who got PPP loans, and this changed that rule as well.
Yeah, just a couple of additional comments here. We've already seen a couple questions in the Q&A. When we talk about the option to have the 8-week period versus the 24-week forgiveness period, that is binary. So you can either have an 8-week period or a 24-week period, but nothing in between. We'll talk about that a little bit more. The other thing to think about here is when we talk about the extension of the maturity date for the newer loans approved on or after June 5th, there is also within the statute an option for lenders to extend existing loans up to that 5-year period. From the banks that we work with and talk to, I don't think any of them are really looking to do that and take on that burden. And hopefully that's really irrelevant, because with these changes, certainly the hope is everybody's going to be getting full forgiveness anyway.
And
so we'll move on to the next slide.
And actually, I'll make a comment too on this slide. I've had this question kind of over and over lately. So the 60%, which used to be the 75%, that is not a cliff. So let's say that for some reason you can only get 50% of payroll expenditures in the period that you select. You're not going to receive no forgiveness. There's a calculation that occurs, and you will receive a proportionate percentage of forgiveness. That question has been addressed in a couple of different ways now, and there's really not much uncertainty in that area any longer. And another question that seems to come up that is a little bit confusing: if you received your loan on June 5th or any period after that, then you do not have a choice on the 8 or 24 weeks. You're automatically in a 24-week forgiveness period. And I don't know if we're going to have any clients that experience this, but it's actually been addressed to where as soon as you are assigned a loan number, that is the point in time that they're going to measure the date that you received your loan. It's not actually going to be when the money goes in the bank. So if you received a loan number on June 3rd, you're going to be in these new provisions where you have a 24-week forgiveness period, versus an 8 or 24-week forgiveness period. So a couple of finer points there, but luckily those have been more addressed now.
Yep. Thank you, Ryan. So we've talked about some of these, we referenced some of these, but I think there's been a lot of, not necessarily, I wouldn't say rumor, but a lot of, people read the statute in a couple different ways. And there's been some subsequent guidance that's come out that's been helpful in telling us a little bit of what the Flexibility Act did not do. First, it did not require the use of the 24 weeks. So we've mentioned that before, but if you were an existing borrower, meaning your loan number was approved on or prior to June 4th, you still have the choice of using that 8-week covered period. And there are substantial benefits to using the 8-week covered period. Probably most importantly is that if you're able to get 100% forgiveness based on that 8-week covered period, you can stop worrying about all of the E and salary reduction, loan forgiveness cutback mechanisms, which we'll discuss in detail later. So it really gives you the flexibility to kind of, be done with the loan, stop thinking about it, and run your business the way that is in your best interest without having to worry about whether you're going to jeopardize your forgiveness. Second, while we're talking about this new 5-year term for the new loans, there was no impact on existing loans. And as Jonathan mentioned, a borrower who has an existing loan can go to their lender and request that it be extended to 5 years. But so far, we haven't really heard about a lot of that happening. So no impact on the maturity date of the existing loans. All of the loans under the original statute had to be made by June 30th, and nothing has been done to change that. So, you've got less than 2 weeks. If you haven't gotten a loan already, it's got to be in by June 30th, unless there's some further action. And we haven't heard anything else. And they had an opportunity to extend it in the Flexibility Act, and they didn't. So I think at this point we might be surprised if there was any change to that. Now, this is very important. This has probably been the biggest question we've gotten from banks, that they've gotten from borrowers, your choice is binary. It's 8 weeks or 24 weeks for existing borrowers. And for new borrowers, it's 24 weeks. If you get to 100% forgiveness after 12 weeks, you, as the law and under the current guidance, you can't go to your bank and say, hey, here's 100% forgiveness. Here's my application. You've got to wait the full 24 weeks. And the major impact of that means that those operational restrictions we talked about, such as FTE and salary reductions, that's going to remain in place for the full 24 weeks, even if you could have gotten forgiveness far earlier. So that's why if you have an existing loan, there's a really strong incentive to try to get forgiveness under the 8-week cover period. And finally, all of these calculations, and we'll talk about some going forward, nothing affected the maximum loan amount. So, we'll talk about how you can count more payroll because of the 24-week than you could during the 8-week. That only is a calculation that impacts the amount of forgiveness you can get. All that does is increases the likelihood that you'll get to 100% forgiveness. It has no impact on the size of the loans. You can't go back and get a higher loan as a result of these changes. So that's something that's been a little confusing, and want to make sure that was clear here.
And Kevin, one thing was interesting for me is if you just read about the hearing that occurred recently on this program, there's discussion about the fact that there's about $133 billion of money that is unused at this point. So there's a lot of money left in this program, and we're getting closer to the June 30th date. And I agree with you that they're probably not going to extend it, but there is some discussion about a new program after this. And then Mitt Romney was commenting that if there was a new program, he would prefer that it would be the eligibility criteria would be having more to do with a reduction in revenue in your business. So anyways, nothing, like you said, has happened yet, but there's definitely some discussion already about a new program or what they're going to do with these remaining funds.
Yeah. But certainly absolutely no reason to wait.
Yeah, that's right.
Thank you. So what has happened since then? The statute came out. The Flexibility Act is only, I think, 10 pages, and a lot of that's kind of what we call boilerplate. Immediately everyone read through it and then had additional questions. There have been, 3 new interim final rules. Some of those just conform some of the previous interim final rules to the new statute. We've gotten the new applications that were released, I think, either yesterday morning or the night before, as well as instructions to those applications. We'll talk about those applications in detail. The real takeaway from all of the Flexibility Act is they've really made it where it should be simpler for more borrowers it should enable more borrowers to reach full forgiveness so that there's no loan remaining after that forgiveness process. And it should make it a little bit simpler, especially for the smaller borrowers. So we'll talk about that more when we get to the application details.
Yeah, the overarching theme on the regulatory changes is, this is a very normal process. You have a statute that's put in place, a new law, and then the agency that administers that statute issues regulations to tell you how you really need to interpret that and what some of the high-level language in that law really means from a practical standpoint. This program has been so unusual because the law is passed and it's immediately effective. And you might remember in late March, this all came out through the CARES Act, and by April 3rd, we're looking at actually putting money on the street. So this is all happening in real time. So if you found this program to be really confusing or been frustrated with some of the information that you've been getting changing, that's really the reason why. And that's why some of us shudder a little bit when they start talking about new programs, because this sort of thing is far from normal business for most of us.
Yeah. Ryan, you want to flip the next slide for me? All right, here are some highlights of the new rule. The 24, and some of this has been informed by the guidance. Well, a lot of this has been informed by the guidance that's come out subsequently. When you're looking at your payroll, which is going to be the bulk of the forgiveness application for most people, if you're using that 24-week period, the previous rule had some guidance that said you were capped at $15,000 per employee, and that math was 8 weeks divided by 52 weeks times $100,000. They have come out and clarified that $15,000 is now $46,000. So this is going to enable you, if you're payroll heavy, as I think most people will be, even if you had some salary reductions, it'll allow you to get to the dollar amount a little bit easier to achieve 100% forgiveness. Even though obviously if you have salary reductions or headcount reductions, you may be subject to the cutback rules we'll get to in a minute. And then for those of you, for those self-employed, sole proprietorships who are getting that owner compensation replacement, it's even, I think, a little more generous for them. That was also previously capped at $15,000, and you can now get up to $20,000, which is 2.5 months rather than 8 weeks of the $100,000 owner compensation replacement.
But you have to go to the 24 weeks to do that. You have to choose that.
That's right. Yeah. So you can't use, if you're an existing borrower and you're planning to use the 8-week period. If you can get full forgiveness, by all means, go ahead and do it. But you may not be able to get full forgiveness under this rule if you're going to stick to the 8 weeks.
Yeah, a lot of what you see in these rules is most helpful to the sole proprietors, independent contractors, people with that form of borrower. I know a lot of people on this call are, more robust small businesses. Maybe you've got an accounting department that is it's kind of overseeing this for you. Net, at the end of the day, these rules and these changes aren't quite as helpful for those businesses. But from a policy standpoint, there were so many small sole proprietors, getting $20,000 and $30,000 loans that it really did make a big impact to be able to help out those people who a lot of times don't have sophisticated record keeping. So the takeaway that you'll see here, certainly from our perspective representing banks, none of this was terribly helpful to banks. In fact, it created a lot more confusion. And then, some marginal benefits for a lot of other small businesses, but a big impact on those sole proprietors.
Yeah, and then another point about this owner cap amount of $20,833, that includes for a owner employee, it includes the insurance and the retirement benefit. Where for an employee, you've got these caps plus, in addition to that, insurance and retirement benefits.
Ron, if you want to go to the next slide, and I think Jeff's taking this one.
So this was kind of a big deal, and because of the changes here, we wanted to make sure that we talked about this. And there's still some confusion once again because we had a rule prior to this, and now this new rule. And it's important to note that in regard to payroll, you've got a couple of choices where you can calculate the payroll in the covered period. And it used to be that everybody was thinking it had to be the payroll that was actually paid in the covered period. And then once again, just to remind everybody, the covered period is the date that the money was deposited into your account, and then it's either the 8-week period of time that you've selected or the 24-week period of time that you've selected. So that's what we mean. That's what we mean by covered period. And with this new rule, if you deposit, let's say that you received your PPP money on June 1st, but your first payroll that was actually paid was on June 3rd, you have an option to begin, for purposes of this calculation, your covered period on June 3rd, just for purposes of your payroll cost. And if you do that, then you'd start your 8-week period of time or your 24-week period of time. So it's called an alternative payroll period. And another big deal about this was people were worried that, okay, I'm going to get to the end of my payroll period and I've incurred the cost because people have worked and they've earned their compensation in this period, but I'm not actually going to pay the payroll until after my covered period. So now they're saying that at the end, as long as you've incurred the cost and then pay that amount in your next payment period, which might be outside of the covered period, that is allowable cost in regard to the forgiveness application. So for most people, what all of this means is you receive your money on a particular date, you add up all the payrolls that you've actually paid in cash, for the period that you've selected, the 8 weeks or the 24 weeks, and then at the end, you include any payroll that was incurred but not actually paid until after your covered period, and that's the allowable payroll cost. So there's no reason to be trying to accelerate payrolls, manipulate payrolls, to where they're actually in your covered period, because we're more on an accrual basis in regard to this calculation. And there was a lot of discussion before about bonuses, not necessarily hazard pay, because we always felt like that was includable. And there's no problem in regard to bonuses being part of this covered cost. And then just keep in mind that we've got these limits that we just discussed in regard to the $100,000 that you're capped at, and then that proportion of that over the covered period. Okay, next screen. So there's some differences that you have to pay attention to if you're an owner employee or if you're self-employed versus if you are not, in regard to what's eligible cost and what's not. And there's a recent change that we're talking about, and I think in a few slides in a minute, in regard to this computation and what you're limited to in regard to an owner employee. And we are interpreting this at the moment to where if you have a Schedule C or a Schedule F, and this is defined specifically in this new interim rule, you're limited to $20,833 of compensation that is eligible, for forgiveness. And because this rule is specifically pointing out Schedule C's and Schedule F's, and it's not pointing out any other type of entity. At the moment, we're thinking that if you're an S corporation, you're not limited to this $20,833 as an owner, and you might be limited to the $46,154 computation, which is basically 24 weeks out of 52 total weeks times $100,000. So at the moment, there's some interpretation there, and this could be one of those things that gets clarified, and there's an FAQ that's going to be coming out, where there could be a better description of this calculation in regard to that question, but we just wanted to point that out. And then, like I mentioned before, owner employees are capped by these amounts, and it's based off of your 2019 compensation. And that's another thing you've got to be careful about. In no case could you receive more in regard to these calculations than what you received in 2019, and then subject to these limits, the 24-week limit, or the 8-week limit, the 15,385 if you're selecting the 8-week period of time. And that was
Jeff,
something.
Jeff, that's something new that came out in May with this interim final rule. That was not really part of the original CARES Act. So there's probably some information out there previous to that that said it didn't matter what your 19 compensation was, but for after May 22nd, with this clarification, that owner employees are limited to what they were paid in 2019.
Right. Yeah. So there, if you all, I don't know if you all are, if you were on a previous webinar that we did, but there was a lot of discussion about owner employees maybe being able to pay themselves more money and, to maximize forgiveness. And then with this rule, they're limiting that by saying, look, in 2019, whatever you were paid in that year. So let's say in 2019, as an owner employee, you were only paid $90,000 for that year. Then you're capped at $90,000, and then applying these ratios of the 24 out of 52 weeks, or the 8-week ratio out of 52, and you cannot receive any forgiveness beyond that. And for Schedule C filers, like I mentioned a minute ago, you're capped at $20,833. So there's some thought, without going into all the math on this, that for a Schedule C filer, it's pretty likely that if you select the 24-week period of time, that you're going to have 100% forgiveness, if you just kind of go through the math on this. And then there's another point on here as the last bullet, that general partners are capped by their 2019 net earnings from self-employment multiplied by 0.9235. And that point is basically addressing the fact that that difference between the 0.9235 and 100% is the self-employment tax, that a general partner might have, and they're limiting the net earnings to the amount that self-employment less the self-employment tax. And I'm assuming it's the employer portion of the self-employment tax that they're just not wanting you to receive forgiveness for. And the other thing, and you've heard us mention this a couple of times already, that you've got to pay attention to, let's say that you do not have a problem with the salary part. And, I'd say for most people, if you select the 24-week period of time, you're going to have enough salaries to cover your loan forgiveness. If you select the 8-week period of time, it might be more difficult, but we have a number of clients that are sticking to the 8 weeks and are going to have enough even in the 8-week period of time. But let's say you've met that requirement. There's two other things you've got to be careful about that could cause a reduction in your forgiveness. One of them is an FTE reduction, and the other one is a salary hourly wage reduction. So one question I've had numerous times in regard to a salary reduction, if you've got part-time employees and they are working less, but they're still making the same wage, that is not a salary hourly wage reduction. Now, that will hurt your FTE calculation, but it will not qualify as a reduction in regard to the salary hourly wage reduction. And with the salary hourly wage reduction, if you have more than a 25% reduction in compensation to your employees, then your loan forgiveness will be limited by the difference that people's pay might have been cut. And honestly, I have not had a client yet where they cut anybody's compensation. So this has not really been a problem in any of the clients that I've been working with. Now, what has been the more difficult area is the FTE reductions. And we've had numerous clients that have gone through staffing changes and all sorts of situations in regard to FTEs. FTE is full-time equivalent. And these rules that came out were really good about specifying how you calculate these full-time equivalents. And one thing that they ended up specifying, that it's based on a 40-hour week. There was some discussion before that maybe it was 30 hours or something else, and they made it clear that it's 40 hours. And they also made it clear that if you cannot have more than a 1.0 full-time equivalent. So if you've got somebody who's working 50 hours in a week, that's a 1.0, it's not 1.1. And then another thing that they added, just to simplify this calculation, if you have somebody who is less than a 1.0 full-time equivalent, so working less than 40 hours a week, you have an option just to across the board consider them to be a 0.5 FTE instead of calculating exactly what their full-time equivalent is for less than a 40-hour week. So we recommend, if you've got a problem in this area, that you calculate it both ways and you just see if one of those works for you. Okay, we can go to the next screen. And there's some other clarity in this May 22nd rule that in regard to non-payroll costs, they must be paid during the cover period. But the big deal, just like what we were talking about earlier in regard to the payroll costs, they can also be incurred. So once again, let's just say that in your covered period of time, you're sticking with the 8 weeks, and you've made one rent payment, but the next rent payment is not going to be actually due and payable until after your covered period. You're allowed to include that rent payment as long as you've incurred that cost in the covered period. And that this interim final rule just made that clear. And they also pointed out that advance payments of interest on mortgage obligations are not eligible for loan forgiveness. And that question did come up several times where people were hoping they could make some early payments and then include it, but that's not allowable.
Okay, now we're going to talk about these new applications. A preliminary thing right before that, just because I've seen a few questions on this, and I know it is very confusing, but The covered period, no matter what, starts the day that the loan is dispersed, so the day the borrower gets their money. When we talk about when the loan is made, and made, MADE, made is what the term the statute and the guidance uses. That's the date that the loan number is issued and that the loan is approved by the SBA, which is going to be prior to the date the loan is dispersed. The covered period is when that starts, really only matters for determining that 8 or 24 weeks for which you're looking for forgiveness. The date the loan is made is important for determining whether you are a pre-June 5th loan or a post-June 5th loan. It's even more confusing because a borrower may not know when their loan was approved. A bank can get their approval and then they can generate documents and send out documents a few days later to the borrowers, and I think that's probably going to be the most typical case. So if you sign your loan documents on, say, June 10th, there's still a good chance you need to ask your bank what the loan date, what the date the loan was made was, because that could have been before June 5th, on June, or on or after June 5th. So it's very confusing, and it's not necessarily intuitive, because when you think of, from a borrower's perspective, when the loan's made, it seems like either when you sign the documents or when you get your money, but that's absolutely not the way that the SBA wants us to look at it here. Okay, now let's talk about the forgiveness applications. So, the forgiveness application was issued, I think it was last month, the original one. And this new standard forgiveness application is generally consistent with that. There are changes to adjust, there have been changes to obviously reduce from 75% to 60%. They've had some language around the salary reduction safe harbor that we've talked about previously. As a reminder, those you have to look at both of those, which I think Jeff just covered. Ryan,
yeah, just to double down on that point a little bit. If you've had a reduction in headcount based on FTEs, if you've reduced pay for people making under 100,000, just know that that's going to cause you to spend some late night hours and a little bit of headache as you work through these various measurement periods, these exceptions to the rule, the safe harbors. It's very technical as you apply those. And there's multiple options, multiple carvebacks. If you've had voluntary resignations, if you've let people go for cause, if you bring them back prior to the time or refill their positions, it doesn't have to be the same person. If you do all that prior to the time you submit your forgiveness application or before the end of the year, you may be able to get out of that. But in my view, looking at the application, those safe harbors are absolutely the trickiest part in determining whether you're going to have your forgiveness ratcheted down. So we'll talk about the EZ application in a minute, and that's designed to help with some of that. But if you've had migration in headcount or in compensation, get ready. And as we'll talk about as we sum up, it's really important that you start to model what that looks like and understand if you're going to have future changes, that you model what that looks like and how that might impact your forgiveness. So again, just paying a lot of attention and reading very carefully, talking with your advisors if you need to about how all that works, I think is going to be really important as you go through this forgiveness process.
Yep. All right. Flip the next slide, please, there, Ron. Okay. The easy forgiveness application, and this was the most exciting thing that we saw yesterday. And this is, only certain borrowers are eligible, as we've talked about previously. A lot of these rules are really going to benefit more of the smaller, sole proprietors and self-employeds. And this is a great example of that. So if you're self-employed, a sole proprietor, if you don't have employees, you can, definitely use the EZ. And I think, I don't think of any reason why you wouldn't want to use the EZ if you're in that situation. The main benefit of the EZ is it eliminates all of that confusion about the FTE and salary reductions, all of those ways that your forgiveness can get cut back. And so if you don't have to think about those things, by all means use the EZ, and it seems like a no-brainer there. So in addition to self-employed independent contractors, no employees, some employers will be eligible to use the EZ, and there's two different categories here, each with two prongs. The first prong is the salary reduction prong, and that applies under both scenarios. So if you didn't reduce compensation by more than 25% for your employees making $100,000 or less, then you satisfy the first prong. And the second prong is if you didn't reduce headcount or average paid hours between January 1st, 2020 and the end of the covered period. Now, of course, that end of the covered period could run, that could be the 8 weeks, which is probably running, in the next couple, and then if it hasn't already, in the next few weeks, or it could be the 24, which will be closer to the end of the year, if you choose that. And of course, there are exceptions that we've talked about and we'll continue to talk about. If you were unable to rehire those people, unable to replace them, or if you made offers to restore hours that were not accepted, then you can check that box and you'll be eligible to use the EZ. Now, say check the box. It's a lot more complicated than that. As you may imagine, what you're going to have to do is you're going to need to retain documentation of how you came to that conclusion. So, again, this is real easy if you have employees and you didn't reduce headcount, you didn't reduce paid hours, you didn't reduce salary. But if you did reduce salary and you want to rely on these exceptions, you want to really make sure, and again, working closely with your advisors, that you've got some documentation there that shows how you were able to come to the conclusion that you were eligible to check this box. And that documentation doesn't have to go anywhere just yet, but we have no idea about the extent to which these are going to be audited. They've said some things about they've said affirmatively they are going to be doing some auditing. So everyone should proceed as if the SBA may come a year or two from now and ask me to support why I check that box. And you're going to need to have the payroll records and then documentation about we made 3 offers of employment, none were accepted, so forth, all of that. So that all needs to be in the file. Otherwise, if the audit process ever reaches you, you could be looking at a real problem. The second category has that same first prong about salary reductions. But then the second prong is different. This is where you were unable to operate at the same level. Your business was unable to operate at the same level due to the governmental coronavirus restrictions and guidelines. And those are mostly, CDC and OSHA. So that's really where I think mostly for businesses that shut down or had to, substantially curtail their activity to comply with those rules, and not necessarily where they couldn't hire the employees back or had layoffs.
It's been borderline amusing watching the legal community react really throughout this program, but this piece was no different. These are pretty simple statements in this short little application form regarding the exceptions. Were you unable to rehire? Were your offers refused? And all of us as lawyers read that and say, well, what exactly does that mean? Being unable to do it. What do you have to do to know that, well, I was unable to do this? And I think the message that we have to get comfortable with is it means what it says, and we're going to have to just get comfortable making a judgment in that regard. And that's where Kevin's point is so important of document your thinking. If you've got a memo in file that says, look, we took these measures, we couldn't bring these people back to get our numbers back up, you're going to be in so much better position if you actually do get audited. Just for saying, look, this was the guidance we had at the time. This was the interpretation that we made. It's all right there in writing. That's the documentation I'd like to see as a lawyer, rather than having to go back and reinvent. Well, I think at the time we probably made a few calls. Maybe did we put an ad in the paper? I don't remember. Those sorts of things are where the documentation becomes important. It's also important to remember on the headcount reduction. It's very quick and easy to have looked at the rules as they existed before this form and say, well, we're not going to have a cutback based on reduction because our measurement period was here and our average FTE count was over here. Keep in mind that this language is different and not as precise and doesn't have the same optionality as the overall rules. It literally says from January 1, 2020 to the end of the covered period. So that's a different standard. So just make sure that that you actually meet the standard before you submit that application, because as a part of it, you are certifying to the federal government that you meet the standard.
And you'll read about all the criticism of the fact that the complexity of this, and everybody already is probably like, holy cow, how am I going to get all this stuff straight? And I think Congress was reacting to that to some extent and trying to create something that was going to make this process easier. But in my opinion, the small amount of time that you're going to save filling out this EZ application is not really going to save much time overall, because like what to Kevin's point, you really have got to go through these same computations. You've got to get to the same point. To me, by the time you get to that point, the application is a very small part of what it's going to take to know where you're at on all of this.
Yeah, just to reiterate something Jonathan said, Jonathan, correct me if I'm wrong, I think the SBA has actually 6 years, or some of this documentation is to be maintained for 6 years. So it's very unlikely, but you could find yourself in a position 3 or 4 years from now where you're asked to explain how you couldn't rehire these employees or other facets of this program. It'd be nice to have that file at your disposal quickly.
Yeah, absolutely. Whether it's fireproof cabinet or hopefully in a digital format, make sure you can reach that application and supporting documents if you ever need it.
All right, you want to flip to the next slide? I think we've covered most of this, but probably the big takeaway, I mean, Jeff just made this point, is yeah, the application's easier, but it doesn't mean that the paperwork is any easier. And then, this document retention idea, I think we just covered that as well. So let's go ahead and move on to the next one, which are some pitfalls here. So first is, choosing the right covered period. And again, that's what Jonathan spoke about modeling before. If you've got to think about how many dollars you have that you can put in the 8-week application versus, how many you'll have in the 24. And I think in most situations you'll get full forgiveness in the 24, but maybe you may not have full forgiveness in the 8, and you're just going to have to decide sort of strategically after modeling, what you've done with your employees and what you expect to do by the end of the year is where you may think you're most at risk of getting, forgiveness cut back. And I think in a lot of cases, there are going to be situations where even if you don't have 100% forgiveness for the 8-week period, because you are going to get out from under those operational restrictions, it's going to make sense to go ahead and do that. And you're still going to be left with a small, maybe a small piece of a, 1% to your loan, which is not the worst thing in the world.
Kevin, one thing I've thought about, I'd be curious to get your take on this. You don't really have to know, let's say you get to 8 weeks and you know one thing, that you're not receiving full forgiveness. And then you thinking, okay, I've got to make a decision. To me, it's not much of a decision, because you can go to the 24 weeks and then just see at that point which one is better. It's not like you make a decision to go to 24 weeks and then the 8-week option is out.
Yeah, I think the big exception there, Jeff, is when, you're in a situation where your business needs have changed and you probably need to adjust headcount long-term as a result. Does it make more sense for you to get 90% forgiven and go ahead and make those changes in headcount and go about it that way? Or does it make sense to, maintain your headcount, maintain your comp levels throughout the 24-week period? The mistake, and it's understandable that we hear people sometimes make, is, oh my gosh, I don't have full forgiveness at 8 weeks. I want to make sure I get this free money from the government. And yeah, that makes sense, unless you're spending, 6 times that amount that you would be leaving on the table just to avoid the forgiveness being ratcheted down. So I think, as with most cases, you want to just figure out, based on your various scenarios, what's going to work out best.
Right. And then the main point, I think, is it's not a immediate decision. I mean, and that's a good point about, because there is a lot of concern. You go to 24 weeks, you've got to maintain your FTEs, or you would if you were going to use the 24 weeks. But you could get to 24 weeks and then even at that point make a decision whether to use the 8 or the 24.
Yeah, and there's no, and it's kind of, I think, an odd omission, but there's no time frame on when the forgiveness application is due in the statute. It does speak about, for the new loans, 10 months after the 24-week period runs, which we're talking about fall of 2021. But for existing borrowers who had their loans already, in theory, there's no reason under the statute why you can't wait until January to file an 8-week forgiveness application. You should note that some banks, and we've included this in some forms that we've sent to our client banks, some banks do have a covenant in there that says you'll promptly apply for forgiveness. And I think banks want that for a couple reasons. One is just so to make sure the records are fresh, and two, because banks are kind of stuck with these loans on their books, and they're only 1% loans. Banks aren't making a lot of money on those, and so they're kind of incentivized as you are to go ahead and get those off their books. So that is something to be careful of. Although I do also think that if you work with your bank, they may be able to waive that for you if you need it. So kind of very closely to that, it's don't relax. Just like the tax return deadline extension, it's going to be real easy for existing borrowers to look at this and say, I can wait 24 weeks. I'm going to not think about it. I'm busy right now. I'm busy running my business. I'll deal with it when I absolutely have to, much like, we all do for tax deadlines. And again, if you can get full forgiveness right now, it probably makes sense to go ahead and, go through the pain of doing all these calculations and get that application into your bank as soon as possible. And then you can just be done with this forever. There's also, so far most of the rules have come out and they've been pretty favorable to borrowers, but there's always a chance that there'll be some interpretation that comes out later that, because, no one's really dealt with actually reviewing these forgiveness applications. And there's just always a chance that some guidance could come out that, you would have been better off under the previous situation. So that's just something that there's no way of knowing right now. I think we've talked about this plenty, but, if you're thinking about waiting 24 weeks, you're going to have restrictions on your business. And as Jonathan's emphasized, you really need to be modeling this if it's a close call at all for you. All right, Ryan, we're going to move to recommended steps. Thank you. So again, the forgiveness applications out there now, you've got the regular and the easy. We think it makes sense to, this is an older slide that was, a valid 24 hours ago, but no longer. Now we have the new application. As far as we know, it's going to be the final application. We don't expect any further changes, but you can go ahead and start filling that out and start, putting your numbers in there, plugging your numbers in there and deciding what it looks like. And that should help you make an 8 versus 24 week decision. And then of course, always involve your professionals, send it to your accountants. The covered period when, the alternative payroll date is important. Making sure you get all of your expenses in that application and then making sure that you pick the right payroll periods and you're accruing payroll, you're accruing your utilities as we've discussed that you're allowed to. Those are all things that, your accountant, just like when they, help you on your taxes and help you find those savings you weren't aware of. This is an example where they might be able to make sure you get the most dollars in there. And also probably the hardest part is, getting those FTE and salary reduction calculations as accurate as they can be. So with that, I think we're ready for tax. Carl?
Hey, the tax effects on the PPP loan forgiveness is fairly simple. Under the CARES Act, it's specifically in the statute that PPP loans that are forgiven are not included in taxable income. So then the IRS comes along and says, wait, not so fast here. They issued IRS notice 2020-32, in which they take the position that any PPP loans that are forgiven is tax exempt income. And there's already a provision in the tax law for deductions that basically say tax deductions directly related to tax exempt income are not deductible. And they have basically taken that position with regard to the forgiven portion of a PPP loan. Now, I'm not sure if Congress, this was their original intent or not. I know some members of Congress have said it is not, and they've actually introduced a bill to change this, but the fact that they didn't include this in this last bill makes me think that's, the chances of this getting changed is probably not that likely. So this does have a substantial reduction on the benefit of a forgiven PPP loan. One thing I will mention though, when you're trying to decide, okay, what expenses do I want to pay to include in the PPP loan forgiveness, there is no tax difference as long as all the expenses are otherwise deductible. So, whether it's owner compensation, whether it's rent or utility expenses or other payroll expenses. I mean, basically, whatever the amount of the loan that's going to be forgiven, you're going to lose that as a tax deduction on that tax return. So, I mean, that's somewhat simple. I've seen some analysis that would indicate, well, you could have a situation where the shareholder paid additional salary to himself, that it could make a difference. But I've run a lot of calculations on that, and I've yet to come up with a situation where it actually made a difference. So that's all I've got.
I'll mention, if you're a nonprofit, you don't really have to be concerned that this would be considered unrelated business income. For something to be considered unrelated business income, it has to be unrelated income that you receive on a regular basis, and the PPP loan would not be something that you're receiving on a regular basis.
Thanks, Jeff. I'm going to talk for just a minute on the actual accounting for the PPP program and the forgiveness. Not surprisingly, it doesn't really fit within existing GAAP, generally accepted accounting principles. So we were all kind of in limbo waiting to see how this would be accounted for. And really the problem is, legally, the form of this program is debt. If you've got this loan, you actually went to a bank and signed a note agreement with a financial institution, and you legally have debt until it's forgiven. But in the back of everyone's mind, they're viewing this in substance as a grant or some form of stimulus money that they're earning over time. We were, like I said, in somewhat of a state of limbo for a while, but last week the AICPA, which is one of our standard setting bodies, in conjunction with a few others like FASB and surprisingly the SEC, kind of came together and issued a technical Q&A, which is one of their formats to issue guidance. And we were all shocked to find out that they're going to let you do it one of two ways and not require one or the other. So the two things that they pointed out in the Q&A was you can, a borrower can account for this under the traditional FASB debt model, which is ASC 470. And any business can use this method. Any nonprofit can use this method. It's probably the most conservative in our opinion, and it's definitely the easiest to apply. But they recognize that if you really view this in substance as a grant, then you might analogize it to IAS 20, International Accounting Standards 20. There's a governmental grant model there, assuming you meet certain criteria, the main one being that it's probable you'll receive forgiveness. That would allow you to account for the forgiveness over time, which is very different. So the main thing that the AICPA stresses is that disclosure is going to be the most important, and you've got to, assuming you prepare financial statements with footnotes, you're going to have to provide pretty robust disclosures on the accounting method that's used. So if we kind of take a step back and look at the nuts and bolts of each method and the differences, the debt model is pretty straightforward. When you sign that note with the bank and you receive the proceeds, you record the debt liability, record your note payable to a bank, you put the proceeds in your checking account or perhaps a new checking account if you established one. You would treat it just like any other note payable that you have. To the extent you begin incurring interest, you would record that. At the point in time when your 8 weeks or your 24-week period has run and you take your documentation to the bank, they make their determination, they submit it to SBA, who has an amount of time to review this before they actually fund the financial institution, which will then result in them releasing you from that debt. At that point in time, you would have what's called a gain on extinguishment of debt, and it would be recorded in your income statement, likely down below the line, as we call it, maybe other income, just outside of operating income. But the point in time is what's important, and that you would not record that gain. That liability would stay on your books in full until such time as it's forgiven, either partially or in full. The alternative model is the grant model, and when you receive the proceeds under that scenario, you would really just have some kind of liability. You wouldn't call it a note payable, perhaps deferred income or refundable advance when you get it. But as you incur the costs that the loan's actually going to be forgiven upon, you will reduce that liability, with the offset being the income statement as you go along. So as you pay your payroll, as you pay your rent and your utilities, you would reduce those expenses and ultimately reduce the liability, so that over the 8-week period or the 24-week period, whichever it is, you would be gradually recognizing this gain that you ultimately will realize. You could also put that below the line as other income, or show it as an actual reduction before operating income. I guess the main point there to remember is, when do you want to recognize it? Because you're going to have a choice. I think the June 30 year ends are really going to have a decision to make, because I don't see any scenario where anyone has been legally released by June 30th. I think that's a stretch. So if you do indeed pick the debt model, you'll have that full liability on your books at that point in time. If you've chosen the grant model, depending on when you got your loan, there's a good chance you've reduced that liability all the way down to a pretty manageable number by then. So you'll have to talk to your advisor and think about the users of your financial statements and the stakeholders in your business and what's best for them. There's a lot of factors to think about there, but just know that you have a choice. The other interesting thing is going to be December 31st. The 8-week covered period folks that apply for forgiveness early will likely have been fully released. So there may not be much difference between the debt model and the grant model for those, but you could have a scenario where the 24-week period is used, and under the debt model, it's doubtful that many of the 24-week period folks would be fully forgiven and released at that point. So you may still have the full debt on your books at 12/31. But just something to consider and something to talk to your advisor about. And I think that concludes the technical side of what we had for everybody. We've left a few minutes. We were hoping for a little more, but we've got a few minutes left for some Q&A. So I'm going to turn it back over to Jeff to look at some of those questions, and hopefully we can answer them.
Okay, and Ryan, like you said, we're just kind of down to a few minutes. So I've been kind of going through these Q&As, and there are some themes that I think we can just cover in more of a general comment. First of all, if you do not have to make an election in regard to not using the 8-week period of time and using the 24-week period of time. It's just a decision that you make, and like we talked about, you can actually just get to the end of a 24-week period of time and then decide which one works better for you, the 8-week or the 24-week. So it's not an election. And there's numerous questions in here about the 24-week period of time, and the negative of the 24 weeks is everything is still applicable for that 24 weeks. So your FTE calculation, your reduction in wage limitation that could occur. So that's probably the biggest negative about the 24 weeks. You've got to run your business if you're trying to receive 100% forgiveness maybe differently than you would have. And like what was pointed out earlier by Jonathan, you don't want to run your business to the detriment of where you have costs that actually exceeds the amount that you would have saved with forgiveness. So that's kind of a big deal. It's not very attractive to think if you've got an FTE problem that you're going to have to worry about it for 24 weeks. So it's just a decision that you have to make. Let's see. And I think I just answered, there's a question, what would be the reason not to extend to 24 weeks? And that's the big reason, because all the same things apply. And it could be that you're not going to receive more forgiveness over a 24-week period of time. There's a question in here about when to apply for forgiveness, and you can do that as soon as you are ready after either your 8-week period of time or your 24-week period of time. And there was some confusion about the comment in regard to the date that the clock starts running. And from the date that you receive the money in the bank, that's when your covered period begins. Now that's different than if you're trying to measure this June 5th date where you've got this these new options beginning on June 5th. And so what we were talking about there was it's basically when you get your loan number in regard to whether you qualify for these changes that are June 5th and going forward. So it's two different things, but in any case, the covered period is when you actually receive the money in the bank. There's some questions in here about payroll in relation to benefits, and for employees, you're limited to the $100,000 calculation that we discussed earlier, and then you can add on to that insurance and retirement benefits. And for owner employees, you're capped at the $100,000, which includes those benefits. So there's a difference there. Let's see. There's some FTE questions, and one thing I wanted to point out I didn't mention earlier, because this has been coming up a good bit. Just because you select an alternative period in regard to the payroll calculation does not mean that there's an alternative calculation for the FTEs. So the FTEs are for the covered period, and it's as simple as that. But for the payroll, you have a choice. You have the alternative period that you can select, or you cannot select the alternative period, and it's two completely separate things. Guys, do you see any other questions in here that kind of, well, there's a question here, and Carl actually came in my office today, and we talked a little bit about this, and I'm sorry to say this has not really been answered yet. The definition of transportation is not clear even now, and most people think that at a minimum it includes fuel. And I think if you've got transportation vehicles that you're leasing, it's clear that that's includable, because lease expense, either property or real property, personal property or real property, is includable. But beyond that, everybody's kind of guessing, at what transportation means. I don't know if anybody on the panel here has any comments on that.
Maybe
Yeah,
the
we agree with you
FAQs that are
there.
set to drop will address that.
Yeah,
We can always hope.
yeah, that's right. It would be nice not to have to guess on that any longer. And I don't know, so we're kind of out of time here. Does the panel have any other, I know we all have access to these Q&As, anything else that we think would be important to point out?
No, if you submitted a question, we did try to answer quite a few of those in the Q&A function, so please check to see if you got a response there. Apologies that we weren't able to get to all of them, but not necessarily a surprise there. There are lots of questions about this program still to be answered.
Yeah, and I think there's a question I just saw. It's a presentation available for us to print out. And yes, the presentation will be made available on the Malden and Jenkins website. And Jonathan and Kevin, I would assume you all will have it made available, but at a minimum, it'll be available on the Malden and Jenkins website. So Ryan, we can let you kind of finish it off.
Yeah, I appreciate everybody attending today. I know there's probably some unanswered questions, but I would advise you to talk with your advisor. If that's us, that's great. If it's not, you probably still need to be talking to somebody. There's a lot of complexities here, and a lot of room to make maneuvers to get maximum forgiveness. But with that, we're gonna have to close this down since we're out of time. I appreciate everybody's help there. I appreciate all the panelists. Hope everybody has a good weekend. Thank you.
All right, thanks
Thank you,
everybody.
everybody.